Hi, welcome to 3 Minutes on Markets and Money. I'm your host, Lance Roberts. Following Monday's big slide, the market actually rallied yesterday right off the 50-day moving average and actually pushed back up above the 20-day moving average. So sitting here back in position here to try to rally back towards all-time highs. Yes, we're still on this sell signal, and this correction back to the 50-day moving average was certainly expected. But again, as we've said before, with money flows very positive here, doesn't really mean that you're going to get a real big correction in the markets. In fact, more consolidation really than kind of everything else. So kind of expect markets to continue to churn here sideways a bit, maybe even retest new highs. I do want to direct your attention though to what happened on our previous two signals that occurred, because there were two different outcomes in that process. The last time that we had a money flow sell signal here, money flows were very weak, and we did trigger a MACD signal, which did lead to a short-term correction here in the market, a bit of consolidation before the market began its next advance. However, moving back here previously to where we had very positive money flows like we have now and a MACD sell signal, the markets again consolidated for a while before actually getting that correction, a deeper correction back to the 50-day moving average. Again, very similar to what we have going on right now, but as we move further into summer, really August and September, and we get past this kind of next 2 weeks of earnings, there is potential pressure for the markets here in the short term. With our money flow sell signal still intact and the MACD, the market's going to need a fairly strong advance here to turn those back into positive territory. Now, could that happen? Absolutely. But it's the NASDAQ that may be a little bit more problematic here in the short term. The NASDAQ, of course, remains very extended above both the 50 and the 200-day moving average. Again, on a sell signal, just like the S&P, with positive money flows, very similar to what we saw back here previously. Now, again, when we go back to what we saw the last time we had this type of signal, we did wind up with a deeper correction here in the markets. And that occurred, basically, that sell-off occurred well into the sell signal like we have currently. In fact, they're about at the same level here before we saw that deeper correction happen. Now, again, when you take a look at the market where it is currently, breadth remains very poor here. Only about 45% of stocks actually above their 50-day moving average, even though the index is above its 50-day moving average. A lot of this money is being pushed into the NASDAQ stocks, particularly the FAANG stocks in general. So money hiding in those areas of high liquidity and safety for hedge fund managers, which suggests there's an easy out as well. So if we do begin to get into the process of a correction later on in August or September, that'll be where the money comes out of. So the risk to the markets over the course of the next couple of months really is in the NASDAQ more than it is in the S&P 500. Both will decline, but there's a risk of a bigger decline in the NASDAQ itself. Now, again, the risk of a 5% correction is still well within the mix here. In fact, there are very few years in history where you don't have a 5% correction. In fact, going back to 1957, there's only about 5 years that have not had a 5% correction out of all the years in the market. So again, there's a very high probability of a correction over the course of the next couple of months. Again, that will probably manifest itself in the larger cap names. May see some rotation into smaller or mid cap names. They did do well yesterday. A lot of short covering in those areas though as well. So again, be a little cautious here. Again, no reason to be overly negative about markets or overly defensive in the short term, but do pay attention to what's happening with earnings and particularly watch those rates, because rates are telling us that something is potentially not quite right in the markets. I'm your host for 3 Minutes on Markets and Money. We'll be back here tomorrow.